Tom Lee just dropped a monster call on CNBC. The S&P can get to at least 7,000 this year. Lee, Fundstrat's head of research and CIO, says the pullbacks are being bought. AI is still the engine, and despite the macro noise, he's bullish into year-end. In today's video, we'll roll the clip, then I'll break down exactly what he said, what he's seeing in the data, and how I'm thinking about positioning. And stick around, because after my reaction I'll walk you through 3 S&P 500 stocks on my buy list right now, using the same framework Tom's talking about: earnings durability, AI tailwinds, and real cash flow power. If you're new here, welcome to the channel. Hit like, let's push this one to 1,000 likes. Drop your thoughts in the comments and subscribe so you don't miss the next big market setup. Alright, here's what Tom Lee had to say.
It does take us to our talk of the tape, the rally's road ahead. I mentioned that call from Tom Lee. He does join us now. He's a CNBC contributor. It's good to have you back. Welcome.
Great to see you, Scott.
So what do you make of just how the market's trading today? We've had a nice run. It's given a little bit back. Maybe some concerns are out there about the strength of the economy, the labor market, some other stuff. What do you see?
Well, I think markets are trying to balance a few things, because we are navigating a little blind because of the government shutdown. But we also know that the real powerful driver of the equity market and the economy has been AI, which is not affected by this slowdown. So I think stocks are in this sort of zigzag pattern, but given we're in that seasonal period from October to year end, and we think the S&P can get to at least 7,000. It has been, and we've seen it this week, these pullbacks get bought. So we could be weak today, and I think we could rally tomorrow. And in general, I'd still be bullish into year end.
Are we whistling past the graveyard, Tom, on anything that could be concerning to you? I see a story right in front of me from Axios mentioning a Moody's analysis. 22 states are in recession or close to it. There was that Carlisle independent survey the other day showing the labor market is much worse than expected. Gold's been going up. Some suggest that's de-risking from the U.S. AI bubble. You mentioned the shutdown. Are we complacent towards any significant risks that we might be missing?
Well, I do think markets are less skeptical than they were in April and even in August and September, and we can see this in both positioning and AAII. So I think it is fair to say that the markets have priced in more good news. So like the things you flagged can be worrisome. But what I'd point out is that I think the AI story is actually strengthening, Scott. From our conversations with both companies and investors, it actually seems like the payback for AI, whether it's applications or services or companies' actual ROI, actually has improved in the last quarter or so. So I think that's what's helping actually create demand for spending. So I think we may be underestimating the sort of profit creation coming from AI, and I think that's why there's still legs to that story. But you're right. On balance, the data is mixed, and we don't really know because we don't have government data.
Yeah. You gave our producers this line that you still think it's the, quote, most hated rally. And I've asked you about this every time you've been on with me. I feel like now that's a little bit far-fetched to suggest that this is still the most hated rally. I don't find anybody who comes on, certainly not on the programs that I do, that is overly negative about anything. The prevailing view, even from those who were cautious before, like the stock market's going higher. Now, it may end poorly way down the road, but it's going higher. So how can you suggest that it's still so hated?
Well, there's this thing where people can make like a backhanded compliment. Like they might say something positive about the market, but they're really bearish. Because when I hear people say, oh, well, this reminds me of 1999, or, they're ringing the bell on the top of AI stocks, they are maybe acknowledging that the market is strong, but then they're trying to mark the end of that rally. And I think, for me, who was an analyst in the 90s, people forget that Cisco in September 98 was almost a 60 PE when the Fed made its first cut in 9 months, and then its PE went to 200. NVIDIA is that stock today, and it's trading at around 27 times forward earnings. I mean, it's got a lower PE than Walmart and Costco, which are like 35 to almost 50 times. So I just think a lot of good news has been accepted by markets, but I don't think it's necessarily priced into markets.
Tom starts by framing the market mood as a zigzag phase, pullbacks that get bought, driven by a tug of war between messy, incomplete macro data and a still powerful AI investment cycle. The government shutdown backdrop means some official data is delayed or noisy, so everyone's flying a bit blind. But his core point is that the real engine, enterprise and infrastructure spend tied to AI, doesn't pause just because a government report is late. In plain English, the market is choppy, but dips are opportunities because the structural driver, AI capex and adoption, is intact. He layers in seasonality next. From October through year-end, markets historically have a tailwind. Within that context, he suggests further upside into the close of the year, even after a solid run. He tosses out a bold destination, an index-level target that implies meaningful room to climb from here. Whether you agree with the exact number or not, the takeaway is direction. He's still leaning bullish into year-end because the AI thesis keeps feeding earnings and spend. Now, the pushback he gets is important. The host lists a slate of worries. A Moody's red showing more than a dozen states flirting with recession, a Carlyle survey hinting the labor market's softer than headline numbers suggest, gold rising as a sign of de-risking, and the shutdown itself. The question is whether we're whistling past the graveyard. Tom's answer is nuanced. Yes, skepticism has faded versus spring and late summer. Positioning is less defensive, but he argues the AI return on investment story has actually improved in the last quarter. He says both companies and investors are seeing faster or clearer payback from AI deployments, applications, services, and workflows that are beginning to show tangible ROI rather than just slide deck promises. If true, that's the kind of thing that sustains capex and expands profits even if the macro is mixed. Let me translate that to what it means for us as investors. When AI spend is speculative, it trades like a story. When AI spend is demonstrably accretive, cost saves, automation, revenue lift, it becomes operational. That shift from narrative to numbers is what extends cycles. It's why you can have soft patches in macro data while AI-exposed firms keep ordering capacity, hiring for AI roles, and integrating models into products. It doesn't immunize the market from drawdowns, but it does put a floor under earnings expectations in certain pockets. The most interesting exchange is about sentiment, the most hated rally label Tom keeps using. The host challenges him, saying it doesn't feel hated anymore. Most guests now admit stocks are heading higher, at least for a while. Tom's rebuttal is subtle. He hears the compliments, but they're backhanded. Yes, it's up, but it's 1999 again, or AI bell is ringing at the top. In other words, the tone has shifted from outright bearish to reluctant acceptance with constant top calling. That matters because reluctant acceptance is not the same as euphoric risk on. Markets typically top when the crowd is all in, not when they're praising with one hand and pulling the fire alarm with the other. To make his valuation point, he goes to history. In the late 90s, when the Fed began cutting, beloved growth leaders like Cisco were on eye-watering multiples, and then re-rated even higher during the mania. He contrasts that with today's AI leader, NVIDIA, arguing it trades at a much lower forward multiple than defensive consumer staples, retail darlings like Walmart or Costco. The message isn't buy anything with AI, but rather relative to its growth and cash generation. The market isn't actually pricing today's leader like 1999. Whether you agree with his exact comps or not, he's making a relative valuation, relative growth argument. The epicenter of AI might not be where the bubble is, at least not yet. Here's where I land on that. Comparing eras is always tricky. Business models, rates, and market structure are different. But the spirit of his point holds. Bubbles are excess relative to fundamentals, and fundamentals here, data center demand, model training, inference spend, software and services on top, are still expanding. If AI ROI is indeed improving at the enterprise level, that's fuel for a longer runway. The warning sign to watch isn't just price going up, it's multiples exploding while forward estimates stall. Right now, the debate is less about multiples blowing out and more about how sustainable the earnings ramp is across the stack. Chips, networking, power, cloud platforms, and applied software. Let's talk risks, because Tom doesn't deny them. He just sizes them differently. Apache Economy state-by-state soft survey reads on employment, and a bid in gold could all signal stress. Add the data blackout from the shutdown, and you've got uncertainty. His hedge is the AI earnings engine. My view, that works as long as credit conditions remain orderly and energy power constraints don't choke deployment. If we saw a real credit accident, a steep demand shock, or a sudden policy mistake, even AI beneficiaries would get marked down. so you don't ignore macro, you prioritize names with balance sheet strength, pricing power, and sticky demand tied to AI workflows. What do you do with this into year-end? Here's how I'd translate Tom's framework into practical takeaways. First, respect the chop. If we're in a zigzag buy-the-dip regime, you plan entries, not chases. That means staging buys on red days rather than green breakouts, and knowing your invalidation levels. Second, separate AI story from AI cash flow. Favor companies where AI impact shows up in measurable metrics, backlog growth tied to AI projects, CapEx visibility, consumption-based revenue ramp, or unit economics that improve with model adoption. That's how you reduce the risk of paying for hype. Third, keep a watch list of risk signals. If the most hated rally truly morphs into uncritical euphoria, everyone stops top calling, positioning gets one way, and valuations disconnect from estimates, then you fade strength. Until then, skepticism plus rising earnings is a friend, not a foe. Fourth, mind the calendar but don't depend on it. Seasonality is a tailwind, not a thesis. Use it to time ads, not to justify low-quality exposure. Lastly, position size matters. If you share Tom's constructive view but respect the macro landmines, you size so a pullback doesn't force you out at the worst moment. That's how you benefit from the dips get bought dynamic he's describing. To wrap it up, Tom Lee's argument is simple. Despite noisy macro signals and a lot of top calling, the AI ROI flywheel is strengthening, which supports equities into year-end. I agree with the thrust, especially the distinction between reluctant acceptance and true euphoria, but with the caveat that you still need to be selective and disciplined. In this phase, it's less about calling a grand top or bottom, and more about aligning with durable earnings power while letting volatility work for you instead of against you. If you found this breakdown useful, tell me what part of Tom's take you agree or disagree with, especially the sentiment piece and the valuation comparison. I'll pin the best arguments and we'll keep the conversation going. This video is sponsored by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now, let's dive into the 3 S&P 500 stocks to buy now. First up is Intel, ticker INTC. Yes, the same Intel that's been written off by many after years of stumbles. For a long time, Intel was the undisputed king of the semiconductor world, powering everything from personal computers to massive data centers. But over the past decade, the company lost its edge, falling behind rivals in both technology and execution. Many investors and tech enthusiasts have counted Intel out, assuming its best days are behind it. But if you look closer, there's a much bigger story unfolding, one that the market seems to be missing. Here's the opportunity. The market is overlooking Intel's massive turnaround. While the headlines have focused on Intel's missteps, the company has quietly been laying the groundwork for a comeback that could reshape the entire semiconductor landscape. The stock price reflects years of disappointment, but beneath the surface Intel is making bold moves that could pay off in a big way. Under CEO Pat Gelsinger, who returned to the company in 2021, Intel is undergoing a dramatic transformation. Gelsinger's vision is to turn Intel from just a chip designer into a global foundry powerhouse. That means opening up Intel's world-class manufacturing facilities to build chips for other companies, not just for itself. This is a huge strategic shift, one that could unlock entirely new revenue streams and position Intel as a critical player in the global chip supply chain. This move puts Intel in direct competition with industry giants like TSMC and Samsung, who currently dominate the foundry business. The global foundry market is worth hundreds of billions of dollars, and demand is only growing as everything from cars to smartphones to cloud servers needs more advanced chips. If Intel can capture even a small slice of this market, the upside is enormous. What's more, governments around the world are pouring billions into domestic chip manufacturing, recognizing that semiconductors are the backbone of modern economies and national security. In the US, Intel is the primary beneficiary of this push, securing massive government support to build new, state-of-the-art fabrication plants, known as fabs, on American soil. These investments are designed to reduce reliance on overseas suppliers and ensure a stable, secure supply of advanced chips for years to come. These new facilities aren't just about making chips for Intel's own products. They'll also manufacture advanced chips for other companies, including some of the biggest names in tech. This foundry business could become a high-margin recurring revenue stream that the market hasn't fully priced in yet. As these fabs come online, Intel will be uniquely positioned to serve both its own needs and those of a growing list of external customers. Meanwhile, Intel's core business, PCs and data centers, remains a powerhouse. Despite fierce competition, Intel still holds a dominant position in the CPU market, which is the beating heart of most computers and servers. And as demand for artificial intelligence, cloud computing, and edge devices explodes, the need for powerful, reliable CPUs is only increasing. While Nvidia grabs most of the AI headlines with its GPUs, it's important to remember that every AI server still needs a powerful CPU to function. Intel remains a leader in this space, providing the backbone for the world's most advanced computing systems. As AI workloads become more complex and widespread, Intel's CPUs will continue to play a critical role. But Intel isn't just resting on its legacy products. The company is rolling out new chips specifically designed for AI workloads like its Gaudi accelerators. These chips are engineered to handle the massive data processing demands of modern AI applications, from machine learning to natural language processing. By investing heavily in AI hardware, Intel is positioning itself for the next wave of tech growth, ensuring it remains relevant as the industry evolves. Despite all these positive developments, Intel's stock remains beaten down, trading at valuations that reflect past failures rather than future potential. But the turnaround is real. With strong government backing, a clear and ambitious strategy, and exposure to some of the most important trends in tech, like AI and onshoring, Intel is set up for a comeback that could surprise a lot of skeptics. Of course, this is a long-term play. Building new fabs and ramping up foundry operations takes years, not months. Execution will be absolutely critical. Intel can't afford more missteps. But for investors willing to be patient, the risk-reward profile is compelling. If Intel delivers on its promises, the payoff could be substantial. In the meantime, Intel's dividend, though recently reduced, still offers a steady stream of income while you wait for the turnaround to play out. For income-focused investors, that's a nice cushion, especially in a volatile market. The company is also taking steps to streamline its operations, divesting non-core assets, and focusing its resources on what matters most: logic, chips, and foundry services. By shedding distractions and doubling down on its strengths, Intel is becoming a leaner, more focused competitor. One of the most ambitious parts of Intel's plan is its 5 nodes in 4 years roadmap. This aggressive timeline aims to leapfrog the competition by rapidly advancing its manufacturing technology. Each successful milestone not only brings Intel closer to technological leadership but also de-risks the investment for shareholders. Another often overlooked asset is Intel's massive ecosystem of partners, developers, and customers. This network gives Intel a unique advantage, allowing it to collaborate on new technologies, drive industry standards, and ensure widespread adoption of its products. The strength of this ecosystem is a powerful moat that's hard for competitors to replicate. Right now, the market is pricing Intel as if its foundry ambitions are a long shot. But with unprecedented government support and a growing sense of geopolitical urgency around semiconductor independence, the odds of success are much better than they appear. Intel is at the center of a global movement to secure chip supply chains, and that gives it a strategic advantage that's hard to overstate. Any positive news, a new foundry customer, a successful chip launch, or a breakthrough in manufacturing could serve as a major catalyst for the stock. The market is hungry for signs that Intel's turnaround is working, and even small wins could trigger a re-rating of the company's prospects. This is a classic value meets growth story, a wounded giant with a clear path to recovery. Intel has the resources, the talent, and the strategic vision to stage one of the most impressive comebacks in tech history. For those willing to look past the noise and focus on the fundamentals, the opportunity is clear. For patient investors, Intel offers a rare chance to buy a cornerstone of American technology at a significant discount. It's not without risks, but the potential rewards are hard to ignore. If Intel succeeds, today's prices could look like a bargain in hindsight. Our second pick is Micron Technology, ticker MU, a global leader in memory and storage solutions. Founded in 1978 and headquartered in Boise, Idaho, Micron has grown from a small startup into a powerhouse at the heart of the digital revolution. Their products are found in everything from smartphones and laptops to the world's most advanced data centers, making them a critical player in the global tech ecosystem. If Intel makes the brains, Micron makes the memory. And in the AI era, memory is everything. As artificial intelligence models become more complex and data-hungry, the need for fast, reliable memory has never been greater. Every time you use a cloud service, stream a video, or interact with an AI assistant, there's a good chance Micron's technology is working behind the scenes to make it possible. Micron is one of only 3 companies worldwide making high-bandwidth memory, or HBM, which is critical for AI and data center growth. HBM is a game changer, enabling lightning-fast data transfer rates that power the latest AI chips from industry giants like NVIDIA and AMD. This technology is essential for training large language models, running real-time analytics, and supporting the next generation of cloud computing. Demand for HBM is exploding as companies like NVIDIA and AMD build out AI infrastructure, and Micron's supply is already sold out for this year and mostly allocated for next. This unprecedented demand surge is creating a supply crunch, giving Micron significant pricing power and visibility into future revenues. The company is working around the clock to ramp up production and meet the needs of its biggest customers who are racing to deploy more AI capacity. The memory market is cyclical, and after a brutal downturn, all signs point to a new upcycle driven by AI, cloud, and device upgrades. Historically, memory prices have swung wildly, but the current environment is different. The rise of generative AI, cloud computing, and edge devices is creating a structural shift in demand, potentially making this upcycle longer and more profitable than previous ones. Micron's management navigated the downturn well, cutting production and preserving cash, and now they're ramping up high-margin products like HBM and DDR5. These advanced memory solutions are not only in high demand, but also command premium prices, boosting Micron's profitability. The company's disciplined approach during tough times has positioned it perfectly to capitalize on the current surge. The memory industry is an oligopoly, just 3 major players, so price wars are less likely, and profitability should be more stable. This tight market structure means that when demand spikes, as it is now, the benefits flow directly to the bottom line. With fewer competitors, Micron can focus on innovation and efficiency rather than constantly battling for market share. Micron's technology edge, with advanced process nodes, means lower costs and higher margins. The company invests heavily in research and development, staying ahead of the curve with cutting-edge manufacturing techniques. This allows Micron to produce more memory per wafer, reduce energy consumption, and deliver better performance to its customers. Their balance sheet is strong, with enough cash to keep investing in R&D and new capacity. This financial strength gives Micron the flexibility to weather industry downturns, seize new opportunities, and outinvest competitors in the race for technological leadership. The company's prudent capital management has earned it the trust of both customers and investors. Like Intel, Micron is a major beneficiary of the CHIPS Act, building new U.S. fabs and strengthening its supply chain. This government support is helping Micron expand its manufacturing footprint in America, reduce reliance on overseas suppliers, and create high-tech jobs at home. The CHIPS Act is a game-changer for the entire U.S. semiconductor industry, and Micron is right at the center of this transformation. The risk is the cyclical nature of memory, but the AI-driven demand shift looks structural, not temporary. While investors should always be mindful of the industry's ups and downs, the current wave of innovation and adoption suggests that memory demand will remain robust for years to come. The world is only beginning to tap into the potential of AI, and Micron is poised to be a key enabler of this revolution. For investors, Micron is a straightforward growth story, a well-run company at the start of a powerful earnings cycle. With its strong market position, technological leadership, and financial discipline, Micron offers a compelling opportunity for those looking to benefit from the AI and data boom. The company's future looks brighter than ever as it rides the wave of digital transformation sweeping across industries. The time to buy cyclical stocks is at the bottom, and that's where we are with Micron. As the memory market recovers and demand accelerates, investors who get in now could see significant upside. History shows that those who invest during downturns are often rewarded when the cycle turns. With Micron's unique position in the memory market, its strong execution, and the tailwinds from AI and government support, it stands out as a top pick for the next phase of tech growth. Now let's shift to fintech with Robinhood. Our third stock is Robinhood Markets, ticker HOOD, the platform that revolutionized investing for a new generation. Launched in 2013, Robinhood set out with a bold mission to democratize finance for all. By removing barriers that had kept everyday people out of the stock market, Robinhood made investing accessible, intuitive, and even fun for millions of users who had never traded before. Robinhood pioneered commission-free trading, a move that forced the entire industry to follow suit. Suddenly, anyone with a smartphone could buy and sell stocks, options, and even cryptocurrencies with just a few taps. This innovation built a massive loyal user base, especially among millennials and Gen Z, who saw Robinhood as their gateway to financial markets. But Robinhood's ambitions have grown far beyond being just a trading app. The journey hasn't been without turbulence. Robinhood faced intense scrutiny during the meme stock frenzy, with the headlines questioning its business practices and regulatory compliance. The company's stock price took a beating after its IPO, reflecting both market volatility and skepticism about its long-term prospects. Yet, instead of retreating, Robinhood has used these challenges as a catalyst for reinvention. Today, Robinhood is evolving into a full-fledged financial services platform. The app now offers retirement accounts, a high-yield cash sweep program, a sleek new credit card, and expanded crypto trading options. These additions are designed to meet users at every stage of their financial journey, from their first investment to long-term wealth building and everyday spending. By rolling out these new products, Robinhood is making its platform stickier, encouraging users to keep more of their money within the ecosystem. This not only deepens user engagement, but also diversifies Robinhood's revenue streams, reducing its reliance on volatile trading fees and payment for order flow. Now Robinhood earns from interest on cash balances, subscription services, and even interchange fees from its credit card. The results are starting to show. Assets under custody have been climbing steadily, a clear sign that users are trusting Robinhood with more of their savings and investments. This growth in AUC is a powerful indicator of the platform's increasing relevance in users' financial lives, and it sets the stage for future monetization opportunities. One of Robinhood's most promising revenue drivers is Robinhood Gold, its premium subscription service. For a monthly fee, users get access to higher interest rates on cash, larger instant deposits, and advanced research tools. This high-margin, recurring revenue stream is helping Robinhood build a more predictable and sustainable business model. Robinhood's crypto business is also a major growth engine, with one of the largest crypto trading platforms in the U.S. Robinhood is well-positioned to benefit as digital assets become more mainstream. As the regulatory environment for crypto matures, Robinhood's early investments in this space could pay off in a big way, attracting both new users and additional revenue. Importantly, Robinhood has achieved GAAP profitability, a milestone that many fintech startups never reach. This demonstrates that the company's business model is not only innovative but also financially sustainable. Profitability gives Robinhood the flexibility to invest in new products, weather market downturns, and compete with much larger financial institutions. Behind the scenes, Robinhood has tightened its cost controls and sharpened its operational focus. The company has become leaner and more disciplined, prioritizing efficiency and long-term growth over rapid, unsustainable expansion. This new maturity is evident in everything from product development to customer support. The recent launch of the Robinhood card is a strategic move to deepen user engagement. By integrating spending, rewards, and investing, Robinhood is creating a powerful flywheel effect. The more users spend, the more rewards they earn, and the more they're encouraged to invest, all within the Robinhood ecosystem. What's especially exciting is Robinhood's demographic advantage. Its core user base, millennials and Gen Z, are just entering their prime earning and investing years. As their incomes grow, so will their financial needs, giving Robinhood a multi-decade runway for growth. This positions the company to capture a significant share of the next generation's wealth creation. Regulatory risks, which once loomed large, have eased considerably. Robinhood has worked closely with regulators to strengthen its compliance and risk management, earning recognition as a legitimate regulated financial institution. This new status opens doors to new products and partnerships that were previously out of reach. Of course, competition remains fierce. Legacy brokers are fighting to win back market share, and new fintech startups are constantly emerging. But Robinhood's brand, user experience, and relentless focus on innovation continue to set it apart from the pack. Ultimately, investing in Robinhood is a bet on a visionary founder and a platform that's only just beginning to monetize its massive user base. The company's leadership has shown resilience and adaptability, steering Robinhood through both boom times and crises. As the narrative shifts from meme stock app to fintech powerhouse, Robinhood stands at the threshold of its next chapter. With a growing suite of financial products, a loyal and expanding user base, and a proven ability to adapt, Robinhood could see significant upside in the years ahead. Let's wrap up. So, there you have it. 3 S&P 500 stocks I believe are undervalued and poised for growth: Intel, Micron, and Robinhood. Each tells a different story, but all share one thing: the market hasn't caught up to their improving reality. Want more in-depth analysis and real-time trade alerts? Join the Stocks Galore Patreon, link in the description. Now, I want to hear from you. Which of these 3 stocks has the most compelling growth story for the next 5 years, and why? Let me know in the comments. Don't forget to like, share, and subscribe for more investing updates. Thanks for watching, and I'll see you in the next one. End of script.